Welcome to my channel MCQ series. All questions are taken from Wiley, HOCK, GLIEM and IMA support package and CMA retired question. First question. Each share of non-participating 8% cumulative preferred stock in a company that meets its dividend obligation has all of the following characteristics except option A, voting rights in corporate elections, option B, dividend payment that are not tax deductible by the company, option C, no principal repayments, option D, a superior claim to common stock equity in the case of liquidation. So, answer option A is correct. Next. Financial manager usually prefers to issue preferred stock rather than debt because option A, payments to preferred stockholders are not considerable fixed payments. Option B, the cost of fixed debt is less expensive since it is tax deductible even if a sinking fund is required to retire the debt. Option C, the preferred dividend is often cumulative whereas interest payments are not. In a legal sense, preferred stock is equity, therefore dividend payments are not legal obligation. So answer option D. Option D is correct. Next question. The following excerpt was taken from a company's financial statement. 10% convertible participating $10 million. What is most likely being referred to? Option A, bond. Option B, common stock. Option C, stock option. Option D, preferred stock. So, correct answer is D, preferred stock. Next. Preferred and common stock differ in that option A, failure to pay dividends on common stock will not force the firm into bankruptcy, while failure to pay dividends on preferred stock will force the firm into bankruptcy. Option B, common stock dividends are a fixed amount while preferred stock dividends are not. Option C, preferred stock has a higher priority than common stock with regard to earnings and assets in the event of bankruptcy. Option D, preferred stock dividends are deductible as an expense for tax purpose while common stock dividends are not. So this question answer, correct answer option is C, option C. Next. Unless these shares are specifically restricted, a holder of common stock with the preemptive right may share proportionately in all of the following except option A, the vote for directors, option B, corporate assets upon liquidation, option C, cumulative dividends, option D, new issues of stock of the same class. So correct answer option C, cumulative dividends. Okay, next. Which of the following is usually not a feature of cumulative preferred stock? Option A, has priority over common stock with regard to earnings. Option B, has priority over common stock with regard to assets. Option C, has voting rights. Option D, has the right to receive dividends in error before common stock dividend can be paid. So, correct answer, option C. Okay. Next. Preferred stock may be retired through the use of any one of the following except option A, conversion, option B, call provision, option C, refunding, option D, sinking fund. So correct answer C, refunding. Next, Environment current capital structure is shown below. This structure is optimal and the company wishes to maintain it. Debt 25%, equity preferred is equity 5, common equity 70. Inner management is planning to build a $75 million facility that will be financed according to this. Desired capital structure. Currently, $15 million of cash is available for capital expansion. The percentage of the $75 million that will come from a new issue of common stock is option A, B, C, D. So correct answer option D. Here's the solution. You can watch the solution. Option D is correct, 56%. Right? Next. The DCL Corporation is preparing to evaluate the capital expenditure proposal for the coming year because the firm employ discounted cash flow methods of analysis. The cost of capital for the firm must be estimated. The following information for DCL Corporation is provided. Market price of common stock is $50 per share. The dividend next year is expected to be $2.50 per share. Expected growth in dividends is a constant 10%. New bonds can be issued at face value with a 13% coupon rate. The current capital structure of 40% long-term debt and 60% equity is considered to be optimal. Anticipated earnings to be retained in the coming year are $3 million. The firm has a 40% marginal tax rate. If the firm must assume a 10% flotation cost of new stock issuance, what is the cost of new common stock? Option A, 16.11%, option B, 15.56%, option C, 15.05%, option D, 15%. Correct answer, option B, 15.56%. Here's the solution. You can watch the solution. Next. Question. Myler Corporation has sold $50 million of $1,000 per value 12% coupon bonds. The bonds were sold at a discount and the corporation received $985 per bond. If the corporate tax rate is 40%, the after-tax cost of these bonds for the first year is option A 7.31%, option B 4.87%, option C 12%, option D 7.09%. So correct answer is option A 7.31%. You can watch the solution. Interest is 12% and the annual interest payment on the bonds is $120. Thus the effective tax rate is 12.18. 120 divided by $985, reducing this rate by 40% tax saving, lower the cost 7.31%. Okay, next question. Acme Corporation is selling $25 million of cumulative non-participating preferred stock. The issue will have a par value of $65 per share with a dividend rate of 6%. The issue will be sold to investors for $68 per share and the issuance cost will be $4 per share. The cost of preferred stock to Acme is Option A 5.42%, option B 5.74%, option C 6%, option D 6.09%. So correct answer is option D 6.09. You can watch the solution. Acme cost of capital for new preferred stock is calculated as cost of new preferred stock is equal to dividend divided by net issue proceeds. So 65 into 6% divided by 68 minus 4. 68 minus 4 rupees issuance cost will be deduct, right? So it will come 64. 68 minus 4, 64, and we'll get 3.9 divided by 64. When we will solve this, we will get 3.9, okay, and divided by 64, and answer will be 6.09. It's very simple math. You can get the answer easily. Next question. A firm seeking to optimize its capital budget has calculated its marginal cost of capital and projected rates of return on several potential projects. The optimal capital budget is determined by option A, calculating the point at which marginal cost of capital meets the projected rate of return, assuming that the most profitable projects are accepted. Likewise, option B, option C, option D, and correct answer is option A, right? Go to next question. Thank you for watching. Bye-bye. If you like my videos, if you like my efforts, so please subscribe my channel and press the bell icon. Thank you.